This is the Asia Trade. I'm Paul Allen in Sydney.
I'm Haidi. Stroud-Watts. The top stories this hour. Asian stocks are set to start the week under pressure as investors assess the trade and tariffs picture and a weak US jobs report. Markets now fully pricing in 2 Fed rate cuts this year, beginning next month.
Oil prices fall at the Asia Open after OPEC Plus agrees to another bumper output increase next month.
And Berkshire Hathaway taking a $3.8 billion impairment on its Kraft Heinz stake, the latest hit to a bet that's weighed on the company for years. We'll take a look at how we're setting up. We are seeing that sort of aversion to risk, as it were, as we head into the start of this trading week here in Asia. Looking like Asian stocks are poised to slip on Monday. We had that soft US jobs data that we were just talking about, dragging Wall Street lower, really fueling these bets that the Fed will cut next month after, of course, a degree of caution that we saw, but still a couple of voices of dissent in the last meeting last week. We are seeing contracts when it comes to across Asia looking like they're pointed to early losses. When it comes to Nikkei futures, we're off by about 0.25%. If you take a look at dollar yen as well, we're trading sort of a little bit to the upside there. 147.25 is where we're at, as well as dollar China, as we continue to really wait for more developments when it comes to the US-China trade talks. But of course, the reality, Paul, really kind of dawning upon markets as to what these tariff rates are going to be, and still that uncertainty as to whether there's room for further movement in that 7-day period that the White House has referred to.
Yeah, we'll dig into that in a moment. There seems to be a little bit of disagreement about that, but we do see US futures at least with a light shade of green there. It wasn't a great end to the week for US markets. We had the Nasdaq off almost 2.25%, and Boeing's defense union, we're also hearing, might go on strike for the first time since 1996. A lot of action for crude prices, though. There we see a bit of weakness there. Unsurprising, we're off 0.75% after OPEC Plus surprised us all, increasing production by 547,000 barrels a day next month. So that's it for the production cuts that began in 2023. They've all been reversed. And Saudi Arabia's got the scope to add even more if it wants to keep on defending market share. But we don't have a lot of clarity on the next move. Now, the IEA, for its part, sees the world market on track now for a 2 million barrel a day surplus by the fourth quarter. And got to be some questions about the demand picture here as well.
Well, particularly with all of the uncertainties that we keep referring back to when it comes to global trade. Like, we have had some sort of incremental developments after the dropping of the rates that we saw heading into the end of the week. But Brazil's an interesting one. We've heard from President Lula saying that Brazil is willing to negotiate. The leaders are willing to negotiate, but only if they're treated as an equal. We've seen President Trump sort of try to bring the political element into that, right, using trade as a point of leverage, given that President Trump has said, he would impose 50% tariffs on Brazilian goods unless the Supreme Court in Brazil immediately drops a case against the former President Bolsonaro, who's of course facing these charges that he attempted a coup following the 2022 election loss. So that's all very interesting. And of course, there's a number of other countries that are sort of hoping that talks are still on foot.
Yeah, India among them. And we've heard from the Indian Prime Minister as well, Narendra Modi, urging Indian consumers to buy local. And that adds another dimension to this, really, doesn't it? It's all very well to get US products into the country, but are consumers going to buy them? And you'd say rice in the case of Japan, beef in the case of Australia. Right. Somebody's got to actually go out and purchase this stuff. But if we take a look at how the dollar has been behaving against this backdrop as well, up 1.6% in July, although it did taper off a little bit towards the end. But in terms of wiggle room, when it comes to those tariffs, well, as far as the US is concerned, no, that's it, set in stone. Let's have a listen.
I don't think they will be in the coming days. I think a lot of these, well, I know a lot of these are set rates pursuant to deals. Some of these deals are announced, some are not. Others depend on the level of the trade deficit or surplus we may have with the country. So these tariff rates are pretty much set.
I expect that those matters are more or less locked in, although there'll have to be some, dancing around the edges about exactly what we mean when we do this or that. For the deals that aren't ready yet, they're going to get the reciprocal rates, soon, and then we would expect that there might continue to be negotiations with those countries.
Let's get some analysis now when it comes to this trade picture. Joining us now is Sharyn O'Halloran, who's the George Blumenthal Professor of Political Economy and International and Public Affairs at Columbia University. Sharyn, really great to have you with us. Well, nothing's ever really set in stone when it comes to President Trump and this White House policies, right? Do you think there is still wiggle room, particularly when it comes to some of these nations that have been harder hit than others? For example, the sort of extension that we saw when it comes to tariff rates on Canada.
Right. So, yes, no, I don't think anything is ever set in stone with President Trump. He is the ultimate negotiator, and these are moves to negotiate. They're being done under 301 executive authority, which is used in cases where they're seen unfair or discriminatory types of policies that are being imposed on the U.S. that have damage to both markets or a particular sector. That being the case, what we've seen is when you look at the patterns of those countries that are being subject to 301 decisions and these types of executive orders, that they are the countries where we see the largest surpluses in trade. That is where the U.S. has a deficit with them, or in the case of Canada, it has a large surplus with the United States. We've seen this across a number of different countries, and it's not just the size of the country or the complexity of the trade relations. It seems to be just if there is a surplus. For example, Cambodia and other types of smaller countries which do have a trade surplus, but it's very small relative to the size of the U.S. economy, so it's hard to claim that's their material damage. So I think these are very much negotiating pillars. I do think that there is an attempt by the Trump administration to link these tariffs to different types of side deals. So while they may be there set in stone for now, there's still room for negotiation.
It's interesting to me that when it comes to probably the toughest and obviously the most implications coming from this set of negotiations between the US and China, is this a kicking of the can down the road that they're just going to do another extension because fundamentally, there are very complex and structural issues in these talks?
So China is very difficult to manage given what the supply chain linkages and what the implications are for many of large U.S. companies. And consequently, there is a sense by just imposing a particular tariff, it's not going to actually solve the problem. Apple isn't going to remove all of its production that's in China to the U.S. It's just not a feasible action to take or to anticipate. And so the question is, how does the Trump administration manage what they perceive as discriminatory or unfair trade practices by by using just such a blunt instrument as the tariff? Or are they going to have to think more systematically or holistically about what the actual trade relations are and why they exist as they do?
Yeah, figuring that out's not always easy, though. And I'll give you the case of Australia, where we are a 10% tariff, and Australia has a trade surplus with the US. So it doesn't make a huge amount of sense. Yet there's no US ambassador in Australia to even raise this with, and a lot of other countries are in the same boat. So in terms of trying to negotiate a better deal, I mean, who do you even pick up the phone to at this point?
That's a wonderful question. I would suggest Australia is in the I don't know why I don't call it envious, but they're not on the hit list in the sense is that they do not have a trade deficit. A trade deficit from the U.S. perspective, and consequently, they are not going to be part of these complex negotiations, as we are seeing with China and other countries like Brazil and India, which actually do have interesting patterns of trade, some of which are very complementary to the United States and necessary given what our production process is. Other times, it's just they're just a comparative advantage. It makes much more sense for a labor-intensive country like India to be producing textiles or more labor-intensive goods. This is sort of the theory of comparative advantage. So we can go on about each of these individual cases. Unfortunately, what's going to happen in the end is that there'll be significant pushbacks from partners. And what we'll find is that there'll be segmentation of the global market. And that's what we're slowly starting to see with Europe, with the Asian countries start developing their own sort of regional trading patterns.
Yeah, I wanted to pick up on that point as well. Is that something you see more of, is that countries that are still interested in free and open trade starting to form pacts and relationships with each other, and put it to you, perhaps potentially with China at the centre?
Absolutely. Europe is a good point and example. They are definitely trying to build up their own types of trade relations. They too have found themselves in the situation where they have an imbalance in trade between themselves and China. And so what does that look like? But building up different types of scale and markets within the regional trading partners is going to be a strategy that we're going to be seeing both in Europe, both in East Asia, Australia, all of those types of large trading partners. The U.S. has trading partners with Mexico, Canada. Its other large partner is the European Union, which really is its largest partner. But I think that transatlantic trade is going to come under a lot of pressure.
All right, Sharyn O'Halloran, Professor of Political Economy and International and Public Affairs at Columbia University. Thanks so much for joining us. Still to come on the Asia Trade, Goldman Sachs joins us to preview earnings from Honda and Toyota, and we'll also talk market strategies with Aegon Asset Management. Much more ahead. This is Bloomberg. This is the Asia Trade. The top political stories we're watching out of the US. Texas Democratic lawmakers say they're leaving the state to block a Republican redistricting push, which is backed by President Trump. The walkout will leave the state legislature short of the minimum number of lawmakers required to hold votes. The Democrats who leave will be fined $500 a day, and Texas Attorney General Ken Paxton is calling for their arrests. President Trump has fired the Bureau of Labor Statistics chief hours after the agency released weaker than expected jobs numbers. The president called the data rigged, claiming political bias. Economists from both major parties are slamming Trump's move as baseless. The U.S. Labor Secretary insists that the economy has seen net job gains since President Trump returned to the White House, with businesses set to reinvest thanks to new tax policies and trade deals. Lori Chavez-DeRemer told us that it's time for the Fed to join in, supporting growth by cutting interest rates.
We still have a net positive, almost 500,000 new jobs since the president took office. Where did we see some of these, gains? We saw them in healthcare. We're seeing them in construction. We are seeing the revisions, I know, is something to talk about. And they were unexpected, those revisions. But most of those, 62% of those, were in education and seasonal workforce. So, we sometimes see the numbers catch up to what's on the ground. But I can tell you why we're positive is because the president is delivering on these trade deals, these tariff deals, understanding new countries are moving forward and wanting to be at the table. And why does that matter to the American business owner? As you all know, I've been on my 50-state tour. I just returned from several states. A lot of these business owners had some uncertainty in understanding what was going to happen. But now that the One Big Beautiful Bill is done, I feel like the table has been set, and we're seeing those investments happen. So we've seen positive job growth for sure, and they've been for the American workforce. Native-born workers are taking the lead. All job gains have been native-born workers.
I mean, with all due respect, the positive job growth, the most positive months you saw were still what the Trump administration was calling the Biden economy, right? For the first few months when we saw those big numbers, that was the Biden economy. Now that the Trump policy is taking effect, you're seeing downward revisions of 258,000 over the last couple of months. Only 73,000 jobs added. And it looks like, not just to me, but to participants in this market, that today's weak payroll numbers are a direct result of the conscious policy to limit immigration. And I'm just wondering if that trade-off is delivering the kind of benefits you want to see to U.S.-born workers.
Well, I can tell you this. I've been a business owner for 20 years. When we make decisions, we look at all aspects, and there's certainly snapshots. But what has happened on the ground? The one big beautiful bill by Congress, the president leaning in and keeping the promises made by negotiating fair trade deals for the American workforce. And now what we need is the Federal Reserve to jump in and lower those interest rates. I talked to businesses just yesterday who said, you know, we've invested in our American workers. We're paying attention to our facilities. We're wanting to invest and borrow more money, but they're concerned with borrowing that more money. So that's another leg of the stool that can be done. We should all be rowing in the same direction.
But is it the only leg of the stool that matters, Madam Secretary? Because we had a 3-month run rate adding 150,000 jobs. And now that those policies that this administration has put into effect are active, we're looking at a 3-month run rate of 37,000. So it's drastically fallen. And what it looks like is the policies that you're putting into place are reducing job growth.
Strong job growth has happened, 3.9% over the last year. Consumer confidence is up. Unemployment is holding steady. Again, almost 500,000 new jobs have been added since President Trump has leaned in. I can tell you this, it's not the only leg of the stool for interest rates, but it's one of the important legs right now.
The U.S. Labor Secretary Lori Chavez-DeRemer there speaking with our colleague Matt Miller. Take a look at futures at the moment when it comes to U.S. Treasuries, and it has been quite some turmoil when it comes to the surge that we saw in Treasuries on Friday. Following that weak U.S. payroll report, traders now betting on Fed Reserve rate cuts beginning really imminently in the next meeting. That data really leading to a widening between yields between short and long-dated debt. Profits to those have been betting on steepening, according to a number of fixed income strategists that we've spoken to. We could see this Treasury rally continue as well, and of course that's playing through when it comes to sovereign bonds in this part of the world, Australia, New Zealand, and JGB's ones to watch going into the start of trading here in Asia. But a lot of investors still lacking that steepening view and expecting some of those further gains. So coming at a time just as bond investors were sort of casting some doubt when it comes to one of those favourite strategies, the downward revisions in that data trimming some 258,000 jobs from the tallies in May and June. So we've seen that sort of sending traders through to some new wages on Fed rate cuts. Futures now pricing in 84% odds of a cut next month, at least 2 cuts by the end of the year. More ahead on the Asia trade. This is Bloomberg. Warren Buffett's Berkshire Hathaway has taken a $3.8 billion impairment on its Kraft Heinz stake. It's just the latest hit to a bet that has weighed on the billionaire investor's company in recent years. Bloomberg Intelligence senior analyst Matthew Palazzolo joins us now from New York. So why did we see the markdown, and I guess in the context of the overall capital situation?
Yeah, so really this markdown is not a big deal in Berkshire's overall capital situation. We calculate that markdown equates to 0.6% of their book value. So while it's not great for the investment, clearly, it's not a threat to Berkshire's capital at all.
Well, let's talk about those overall results for the second quarter. Were there any surprises in there?
Yeah, so the overall result came in pretty much right in line with what we expected. It was about $11 billion of operating earnings, and that's when you strip out all of the noise in the portfolio and some foreign exchange, and that came in right where we expected. But there were moving parts in the results. So the insurance results, which is my particular area of expertise, kind of came in below what I had expected a little bit on lower yields in fixed income. So insurance was lower, but then the railroad operations were better, and their manufacturing service and retail unit, which has a varied amount of operations all over, that came in better than expected. And given the results in the first quarter, I thought we'd see more weakness in the second quarter, but that held up a little bit better. So there's inelastic demand for a lot of those products held up, and the railroad held up, and those offset weakness in the insurance results.
So Berkshire has about, $344 billion in cash. Did we see more deployment in this quarter?
So we didn't see much. Warren Buffett has been negative on share repurchase. We feel he's probably viewing the company as kind of close to its intrinsic value. So Berkshire has not been buying back a lot of its own stock. It has also not been buying public equities in other companies either. So the net stock sales and purchases were about negative $3 billion, which means they sold $3 billion more than they bought. We do think, and this is unconfirmed, but just based on our calculations, looking at their results, they have a holding that they kept confidential in the first quarter in their 13F filing. We think they may have added about $2.8 billion to that holding, which might be in the industrial space. We don't know what it is exactly, but we kind of have narrowed it down to that bucket. They may have deployed some capital in that investment, and we may see that in a little while when the next 13F filing comes out.
With Union Pacific making a bid for Norfolk Southern, could that push Berkshire to make an acquisition in the railroad space?
Yeah, so we highly doubt that Berkshire will get in a bidding war for Norfolk Southern with Union Pacific. But our rails analyst does feel if that deal were to go through, and he does think that it might be a long shot for that deal to even go through, but should that deal go through, it would be pretty detrimental for Berkshire's rail business, Burlington Northern Santa Fe. So he feels that they may be compelled to do something. The obvious target then would be CSX, which is a East Coast railroad. Berkshire owns a West Coast railroad. What Union Pacific is trying to do is basically do a transcontinental railroad. And that would be the acquisition that Berkshire would have to make to compete with a Union Pacific transcontinental railroad. It's possible. The market certainly thinks that. It's likely. CSX's stock has run up over 25%, which makes me think Buffett really wouldn't want to do that. The enterprise value of CSX is about $85 billion. We had talked about them having $344 billion of cash. So they could conceivably do an all-cash bid if they wanted to. My gut feeling is they wait it out, but I'm not 100% sure on that. I think anything could happen, that they may make like a one-time final offer and try not to get into any kind of bidding war. But I don't think they go for Norfolk Southern, and it is possible that they do something for CSX.
All right, Bloomberg Intelligence senior insurance analyst Matthew Palazola there. Let's take a look at auto earnings as well due this week. A couple of big ones. Toyota, Honda. Let's start with Toyota. Fiscal first quarter profit. Could see a dip, but of course, record sales that we've seen. Obviously, front loading a factor here before the tariffs really started to hit. So that number we get today may be somewhat skewed by the real politics of the situation. What else have we got? We could see Toyota weighed down by rising supply chain costs going forward. There's possibly going to be a weaker revenue in the US as well. So operating profit guidance for the fiscal 2026, 3.8 trillion yen with a 7.8% margin. So
yeah, Honda's profit likely looking at the same reasons according to Bloomberg Intelligence. We saw in June really a lot of Japanese automakers slashing their US export prices by almost 20%. That was the biggest drop since records going back to 2016. Margins being sacrificed to remain competitive through all of this trade turmoil. But we also heard from Japan on Friday they're going to continue to seek that tariff cut for cars.
Let's check in on how some of these key commodities are tracking at the moment. We're seeing some modest gains for copper and iron ore, still holding on there above $100 per tonne. The real action, though, in the commodity space right now is with crude, because we had the OPEC Plus announcement over the weekend. The production going to be increasing again, 547,000 barrels a day from next month. Saudi Arabia has scope to add even more if it wants to, but we did not get a huge amount of clarity on the next move. The IEA, meanwhile, sees the world on track for a 2 million barrels per day surplus in the fourth quarter, and of course the demand outlook not exactly robust at the moment either. Let's get a little bit more on this with energy and commodities editor Ben Sharples. So Ben, more oil. When is this flood of oil going to end?
Oh, it's a good question, Paul. Probably after this one, I suspect, we're moving into a market that is forecasting, or some are forecasting, are going into a big surplus from the fourth quarter into the first quarter 2026. So I suspect after this, you're probably going to see a pause, even though OPEC Plus is flagging or talking about possibly bringing back more. It's very difficult to bring back more into oil into a market that is likely to see quite a sizable glut.
There's certainly unfinished business, right? How much of that depends on what happens with the global trade outlook?
Well, like most things, Haidi, you've got Trump's tariffs in the background. That's probably the big unknown for many financial markets. If you look at the price action at the moment, actually, 1% move in the morning, this increase was well telegraphed to the market, so the market knew it was coming. Immediately for oil, there's a few things on the horizon that we really need to look out for. There's that 10-day deadline that Trump was talking about for Russia to reach that truce, and what that means for Russian oil. Is that affected? It's a huge part of the market. If that's affected, then we can see prices move again. But at the moment, I suspect you're going to move into a bit of a holding range until we see something on that front. The other unknown is India. Trump has also singled out India in terms of its buying of Russian crude. Is he going to do something there? If so, they'll need more, and those OPEC barrels will go to good use.
Yeah, we heard from sources close to the Indian government suggesting that no decision has been made on whether to halt purchases of Russian oil. But Ben, I want to talk about the demand side as well. How is oil demand holding up at the moment and into the future?
Well, demand is good at the moment. We're in that summer seasonal demand period, so people are travelling, oil is being consumed, so it's good. And that's probably why adding oil into this market, it doesn't look so bad. Once we move past summer and into those winter months where demand goes down, that's when you'll really see the pinch on the market. Prices up around just below 70. You're probably going to see them decline especially if OPEC Plus add more barrels. But we're going in from a period of really good demand, robust demand at the moment, but as we move closer towards the end of the year, it starts to fall off into 2026. It starts to fall off as well, and then you've got that surplus that is putting extra pressure onto oil prices.
What's happening when it comes to rig count in the US, particularly as we're starting to get that weakness in the data come through?
Well, Heidi, you heard Trump talk about, US energy can pick up the slack here, especially in reference to Russia. He made that comment last week. But the reality is, OPEC, the shale guys are hurting as well. The tariffs, they're not getting clarity on the tariffs. It's adding to their business, and we're seeing that rig count fall. So, the shale guys aren't going to fill that void, and they themselves are hurting from the uncertainty or the lack of clarity around these tariffs and everything else that goes on with that. So, it's falling there. It's starting to ease. I wouldn't say fall, it's easing, but it's not a sector that's going to perhaps outperform, I'd say.
Bloomberg's Ben Sharples there with the outlook for crude. And speaking of Russia, President Vladimir Putin says his war goals in Ukraine are unchanged. It comes as the Kremlin continues to rebuff US pressure for a ceasefire with Kyiv. Let's bring Bloomberg's Michael Heath for more. We've also heard that President Trump saying that he's moved to nuclear subs, US subs, after these continued trading of barbs with Russia. But it doesn't sound like Putin's changing his strategy.
No, he's not. And excuse me. And President Trump's, his constant, deadlines that he's been setting. He's shortened it now, and his threat about secondary sanctions. When it comes to India or China, the buying of Russian oil, as Ben mentioned, that is significant. But the question is that there's probably not a lot of belief in Russia that President Trump is going to follow through on this. There's been no signs so far. They have this bill in Congress. The US has this bill that could impose quite severe sanctions on Russia. The deadlines come and go, so we just have to see. If he does actually act on it, then you might see Russia start to more seriously consider things. But at the moment, Ukraine's basically on its heels. Putin also said that Russia's advancing along the battlefield. Now that's at a snail's pace, but nonetheless they're going forward. So the view in Moscow is that the West continues to be divided and weak, and that's perfect. That's what was expected under Trump, and they can keep pushing forward. They pay heed with these prisoner swaps and that sort of thing, but it doesn't look to be anything significant on the horizon.
In terms of acting, though, President Trump has said that, look, he's going to move 2 nuclear submarines in closer proximity to Russia in response to what he called highly provocative statements. Is this highly provocative act going to move the needle at all?
Well, look, I mean, it's quite an extraordinary thing because Dmitry Medvedev, the former president of Russia, is a pretty obscure figure these days. He was moved to the deputy head of the Security Council. He's fallen out of favour. He was once known as a liberal in the Russian administration, and that administration's basically run by pretty hardline KGB guys, and so Medvedev's always seen as weak. So for years he's been issuing these outrageous things on Twitter, threatening to pulverise Paris or London and these sorts of things, and everyone has rightfully ignored him. So the idea that the US suddenly picked up on this to move these submarines, I mean, it'll make Russia take note. There's no question. We may start to see Medvedev tone things down a bit. I mean, it's just the reason that he could get away with it was no one took him seriously. So it may well be that that perhaps President Trump's using that as a way to exert a little bit of pressure. We'll have to see, but a very unusual person to respond to, definitely.
Are we seeing Trump kind of run out of options when it comes to how he's trying to achieve his foreign policy goals?
Yeah, well, I mean, look, what seems to be happening is that having gone through the campaign saying he could fix all these things that President Biden couldn't, reality is starting to make itself felt here. And the reality is you must arm Ukraine. The reality is you must actually take serious measures against Russia. The reality is that the regime in Moscow will only respond to force. And similarly in the Middle East, when Trump does, he does have this, I guess, there's an uncertainty over how he'll respond, which actually is quite helpful for him. But, he has to sort of follow the processes in order to get things done. And when it comes to Russia, it's always been very simple. Show force, show strength, Russia respects strength. Show deference, show division, and Russia will walk all over you. It's not particularly complicated stuff. So what we're seeing is sort of, I guess, a move gradually towards a more mainstream type of foreign policy than we'd seen in, when he was an opposition candidate.
All right, Bloomberg's Michael Heath there. We have more heads on the Asia trade. This is Bloomberg. We'll have Japanese markets opening at the top of the next hour. This is how a few key assets are looking ahead of that. We've still got a fairly weak yen at 147.27 right now. We're keeping an eye on bond futures as well. Pointing up at the moment, we did see bonds rallying pretty hard in the US after that revised payrolls data. We've seen yields slipping in other markets as well. Nikkei futures, meanwhile, pointing pretty solidly to the downside at the moment. It was a pretty weak session to close things out on Friday. Currently, Nikkei futures off by almost 2.4%. Well, Toyota and Honda are going to report earnings this week. Analysts expecting a mixed picture. A stronger yen and US auto tariffs are going to eat into profit despite resilient unit sales. Joining us now from Tokyo is Kota Yuzawa, head of Asia Auto Research at Goldman Sachs. Kota, thanks so much for joining us today. So looking ahead to the earnings from Honda and Toyota this week, what sort of impact do you expect to see from tariffs and the trade environment on the outlook?
Thank you for having me. Yes, we do expect the tariff impact to be quite big for most of the Japanese auto, but it's probably less than feared. Based on 25% tariff over Japanese made vehicle, we were expecting 3.5 trillion negative impact across the board for automotive sector in Japan. But now we can probably see around a 2 trillion yen type of negative impact. Still a big number, but relative to the 25%, very recent tariff update was a positive event and less than feared.
In terms of the quarter that predated the trade agreement between the US and Japan, what are you expecting to see in terms of that impact on earnings, when it comes to front loading?
Well, I think we probably have to closely monitor the situation over Mexico and Canada and the rest of the region. Japan-U.S. trade negotiation went okay. So I think there should be a certain newmaker update from the company management, such as Toyota and Honda. At the same time, we said like 2 trillion yen type of negative impact, but there should be a certain mitigation effort that all automaker will probably try, including the price hike action in the United States starting from September. So we're constantly monitoring the situation, how much they could actually recover from the negative impact of tariff.
Is the outlook when it comes to EVs and hybrid vehicles looking a little like it's going to gain a bit more momentum?
I do think that the hybrid momentum will probably accelerate. It's not directly related to the tariff argument. I think it's more like a milder environmental regulation from U.S. government, ACC2 cancellation, and also the milder mile per gallon regulation in the United States. So starting from October, I do believe that hybrid sales momentum would even accelerate in the United States market. On the back of on the other hand, probably battery electric vehicle sales may probably potentially slow down. For Japanese makers having a large exposure to hybrid sales, it's probably get benefit in the second half of the year.
We've seen Japanese automakers sacrificing margin to an extent to try and stay competitive, particularly when it comes to the US market. Do you think this will change if we start to see major suppliers passing through tariff costs, logistics costs, and is that going to sort of alter the pricing dynamic?
Well, I think not only Japanese makers, but also all automaker operating in U.S. probably have to think about a price hike at any case. And we expect the model year change sometime in September could be the one trigger that all automaker will probably try and raise price in order to mitigate some of the negative impact of the tariff and also the negative impact from the inflation pressure in the United States. Subaru, one of the company, already announced a 4.5% price hike in U.S. back in May 20th. And so far, the situation of the sales momentum for that company not really deteriorating that much. So I think if the price hike action would probably happen altogether, there could be a certain, acceptance among U.S. consumers for this kind of price hike.
Well, all Japanese automakers now facing tariffs in the US that weren't there a year ago. To what degree can Japanese automakers go to other markets that aren't now so heavily protected to make up the gap?
Well, we see increasing competition in the Southeast Asia, Australia, and also the Latin America. Clearly, competition is get intensified based on this tariff argument. Not only Japanese makers, but also other Asian players, OEM, will probably try to gain market share in those countries in order to mitigate the negative impact of the U.S. Having said that, as I mentioned, if the incremental tariff over Japanese made vehicle is at 12.5%, that's already determined, then it is not easy, but it's manageable for almost all Japanese makers to make up certain price action while keeping market share in the U.S. So Japanese makers' U.S. situation could be okay. Then rest of the country, yes, it's a competition, but all in all, I think Japanese maker could probably maintain okay type of margin into the second half of the year.
Do you expect that Japan will have much success in trying to push for lower tariffs on autos with the U.S.?
I do not think so. They're not really trying to achieve volume or market share. They're clearly focusing on profitability. And with this price hike, there could be a certain negative impact based on price elasticity. But I think none of the Japanese maker would try doing a massive promotion in order to just gain market share by sacrificing their margin. I don't really think so. And quite honestly, incremental 12.5%, not going to make any automaker in a critically difficult situation. As I mentioned, 12.5% is something manageable for Japanese automakers.
Kota, really great to have you with us. Kota Yuzawa, the head of Asia Auto Research at Goldman Sachs, joining us from Tokyo. Well, Nintendo says it sold more than 6 million Switch 2 consoles in the product's first 7 weeks on the market. The company kept its full-year forecast unchanged, saying it expects to sell 15 million units by March. For more, Bloomberg's Sharyn Sasaki joins us now from Tokyo. So, obviously, this was a highlight in terms of what investors were looking at. What else jumped out to you in these numbers?
Yes, so the big takeaway from Friday was the strong beat across all major metrics, driven by an explosive start for the new Switch 2 console, and an operating income rose to 57 billion yen, beating analyst consensus by nearly 4%. Net income jumped 19% year-on-year. That's 65% above consensus. The revenue soared 132% to 572 billion yen, and massive growth off the back of 5.8 million Switch 2 units sold and 8.7 million games and in just 7 weeks. Much of this strength came from early global demand, particularly in US and Europe. So Nintendo bundled Mario Kart World, a title that sold 5 million units, with many consoles driving volume but compressed in average selling prices. So despite this blockbuster top line, margin did not expand meaningfully, a clear sign of heavy marketing spend and early cycle hardware dilution.
So it was a strong quarter. Why then did Nintendo leave the full year forecast unchanged?
Yeah, that's a great question. And frankly, that's what puzzled many analysts on Friday. Nintendo reaffirmed the full year revenue guidance of 1.9 trillion yen and operating profit 320 billion yen, both far below consensus expectation. They are still projecting 15 million units of Switch 2 by March, figure that looks low given the current pace. They've already sold 6 million in less than 2 months, but there are clear reasons for this conservative stance. First is the company's cautious FX assumption, 140 yen against the dollar and 155 euro against yen against the euro, and uncertainty around U.S. import tariffs, where 20% duties on Vietnam shipped console could crimp margins. So Nintendo's guidance looks like it's building a cushion, particularly on profitability, even though a potential production upside to 20 million units if they ramp up with Samsung.
What are some of the risks for the second half then?
Yeah, so there are 3 main risks. One is the tariffs. A new 20% U.S. tariff on console assembled in Vietnam could eat into margins. Nintendo President Furukawa said they might pass on those costs to customers, but that could hit demand in price-sensitive markets. USB sees a potential operating loss in hardware segment once tariff bites. Second is sustaining momentum. The Switch 2 Switch 2 is Nintendo's the priciest console ever at $450. And while launch demand has been strong, the question is whether it can maintain sales velocity through third and fourth quarter, especially without the price cut. Then lastly, product pipeline. The October launch of Pokemon Legend DHA will be a major test of software strength. The margins depend on the software outselling hardware, so continued momentum from the first-party title like Donkey Kong Bonanza is crucial. So if the Nintendo executes on both hardware and high-margin software, and tariffs proves less disruptive than feared, there's a case to be made for upward revision to full-year revenue and the profit forecast later in this year.
Bloomberg's earnings specialist Reina Sasaki there on Nintendo. Taking a look at Japanese bonds, which are also, in terms of futures, on the move at the moment. The 10-year bond futures rising as we continue to track the rally in treasuries, the fall in yields that we saw in the Friday session for U.S. treasuries, rallying as traders ramped up their bets on deeper Fed rate cuts, more of them, and starting sooner than expected after that weaker than expected U.S. payrolls number that continues to play out in the Asian session as well. We're also seeing BOJ watchers bringing forward their forecast for Japan's next rate hike. We had some clarity, of course, over trade increasing last week with the Trump administration, including that deal with Japan. Some 60% of economists that we've spoken to seeing the next hike to come as early as October.
And you can catch Japan Ahead every Monday, 8:40 a.m. if you're watching in Tokyo. And subscribers can watch live on the terminal using the TV Go function. This is Bloomberg. Let's check in on some of the stocks to watch when trade opens in Australia, Korea and Japan shortly. Nintendo shares set to react to its earnings report. As we were just discussing, it sold more than 6 million units of its Switch 2 console over its first 7 weeks on the market. Nintendo, though, keeping that full-year forecast unchanged. Nippon Steel's also going to be in focus after announcing it's going to implement improvements to boost US Steel's profit over the next 3 years. Of course, we will be watching Asian energy supplies as well. OPEC Plus agreeing to another output increase, this time 547,000 barrels a day from next month. That pretty much reverses all the production cuts that began back in 2023. Not a lot of clarity, though, from OPEC on what comes next. The IEA, though, sounding a note of alarm on the outlook for demand, seeing a $2 million barrel a day surplus in the fourth quarter. So oversupply, the word of the moment, Heidi.
Yeah, take a look at this global rally that we're seeing, expected to continue when it comes to global bonds after such a period of consternation for global bonds, particularly at that longer end. We're now seeing that big surge, bond yields just falling through the floor on Friday with the US jobs report, really convincing traders and sort of market participants that we're going to see more moves quicker and at least 2 rate cuts from the Fed by the end of the year. Australian government bond futures have been rising too this morning in light of Friday night session. The surprise downward revisions to that payrolls data really spurring that sharp rally that we saw in treasuries. We're seeing a move in New Zealand as well as for these early look at JGBs there as well. We do have cash trading for Aussie government bonds, though, closed on Monday for a bank holiday. The market opens in Sydney, Seoul and Tokyo next, and bond markets will be core to that. This is Bloomberg.
People dead, at least. That's what they have, but I think the number is much higher. And the leaders of each country, Rwanda and the Congo, they were great. They were great, and they wanted it stopped. 31 years it went on. We stopped a lot of wars. Serbia, Kosovo was going to be happening, and I don't believe it will now, so we stopped that one too. Yes?
You said you had more of an update to give us on Gaza, on the Gaza Strip.
Only we want the people fed, and we're the only country that's really doing that. We're putting up money to get the people fed, and Steve Witkoff is doing a great job, and we want Israel to get them fed. We're giving some pretty big contributions, basically to purchase food so the people can be fed. We don't want people going hungry, and we don't want people to starve, and there's some bad things happening.
Do they see evidence of a genocide in Gaza?
I don't think it's that. Look, they're in a war. Some horrible things happened on October 7th, as you know. It was a horrible, horrible thing. One of the worst I've ever seen. I've seen a lot of bad things since I'm president in terms of wars and potential wars. I mean, if you look at the one that we just stopped, there are thousands of people being dead already at the border between Thailand and Cambodia. Thousands of people. And I mean, I've seen some bad things, but that October 7th was with Hamas was really, really bad.
Mr. President, can you give us an update on Steve Witkoff in Russia, and what happens on Friday if the deadline comes and Russia has not agreed to a ceasefire?
Well, there'll be sanctions, but they seem to be pretty good at avoiding sanctions. You know, they're wily characters, and they're pretty good at avoiding sanctions, so we'll see what happens. But Steve is focused right now on the border in terms of, we're talking about with Gaza, getting people fed. And he may be going, I think next week, Wednesday or Thursday, may be going to Russia. They would like to see him. They've asked that he meet, so we'll see what happens.
Mr. President, what advice do you have for Republicans on Capitol Hill heading into midterms? What do they need to do? What can they do to, hold?
Well, one of the things they're going to be talking about pretty soon are the tremendous drop in drug prices. You know, we've cut drug prices by 1,200, 1,300, 1,400, 1,500%. I don't mean 50%, I mean 14, 1,500%, because we're going favored nations. We want the same price as Europe gets. We want the same price as other country gets. And over the years, 25, 30 years ago, it started where they were charging us much more. And I put an end to it, you know, with a letter that you saw last week. So I think that's going to be a point. I don't know how anybody could win an election if they're on the other side of that issue. So we'll be dropping drug prices. It'll start over the next 2 to 3 months by 1,200, 1,300, and even 1,400% and 500%, but not just 50% or 25%, which normally would be a lot, because the rest of the world pays much less for the identical drug, and we're going to be paying the same thing. We're going to have a favored nations. We will pay as low as the lowest nation in the world.
And then, Mr. President, I think it just came out $29 billion in July taken in tariff revenue. You know, could we see a potential rebate here, and what would that look like, and who would qualify?
Well, we're going to pay down debt. We have a lot of money coming in, much more money than the country's ever seen, by hundreds of billions of dollars. And there could be a distribution or a dividend to the people of our country. I would say for people that would be middle-income people and lower-income people, we could do a dividend. But one of the things we're going to be doing is reducing debt. But we have hundreds of billions of dollars pouring into our country now. We should have done this many years ago. And I did it in my first term with China. We didn't get to the rest because COVID hit. And you couldn't really go to France and Spain and Italy and say, let's start talking about some tariffs. But China was paying us hundreds of billions of dollars in tariffs, and we did it then. And then Biden screwed it all up. He screwed everything he touched, he screwed up. So, thank you.
When will you and George win some Earl Sears in the Virginia governor's race?
Yeah, I would. I mean, I would. I think probably she's got a tough race. She shouldn't have. But because the candidate she's running against is not very good. But I think she's got a tough race. But I would, yeah.
When will you swear in Jeanine Pirro to be the
I will happily swear in Jeanine Pirro, who's going to be fantastic at what she does in D.C. Over the next very short period of time. I think she's going to be fantastic. Don't forget, Jeanine Pirro was a great judge and a great prosecutor. And because she was so good, I was there. She was an amazing prosecutor and judge. And because she was so good, they drafted her into show business. And she did fantastic. You know, The Five was the #1 show, et cetera, et cetera. Jeanine Pirro was also really good at that. But her real love is exactly what she's doing. And that's what made her such a success in show business. So Jeanine Pirro is going to be amazing. And I'll swear her in as soon as we can swear her in. We need her. She's going to be amazing.
Mr. President, are you happy with how the Rose Garden turned out? And will you have some type of event for the Rose Garden? Are you happy with how it turned out?
Yeah, we're getting great reviews on the Rose Garden, and we had to do it. As an example, when we had a press conference, you'd sink into the it would take 3, 4, 5 days for it to dry out, and we couldn't use it for really the intended purpose. So whether they had events or they had news conferences, we couldn't use it. And it's a beautiful white stone, and it's a stone that's the same color as the White House itself. And because it's very white, it's going to reflect the heat. It's not going to be very hot, like if you had a dark stone. So, yeah, we've gotten great reviews on the Rose Garden.
Do you have any update on the search for the Federal Reserve Board? Have you been interviewing candidates?
No, I have a couple of people in mind. I'll be announcing somebody for the filling of the person that left. A woman left, as you know, who was I guess a Biden appointment, either Biden or Obama, but I think a Biden appointment. And she left early, and I think she left because she agreed with me on interest rates, and yet they were on the other side of the ballpark, right? So I'll be announcing that probably over the next couple of days.
Mr. President, one more on tariffs here. As you continue to, pile up these trade deals, are you kind of gaining more leverage over countries that haven't come out?
Yeah, I'm not looking for leverage. I'm looking for fairness. We want reciprocal as much as possible. Sometimes reciprocal would be too much for them to handle because it would be a much bigger number. But we want to see some reciprocity. We want to see reciprocal wherever we can. And all I can say is this: our country will be taking in hundreds of billions of dollars. You just said it. Already we're taking in, billions and billions of dollars. And it was very unfair. The world treated us very unfair. But the next big move is going to be the price of drugs. Because you could buy something in London or in Germany, someplace in Germany or many countries where it's 1/10, 1/3, 1/4, or sometimes 1/10 the price of what it costs to buy it in New York or some other place. And we're not doing that anymore. We're not allowing that anymore. That started many years ago when people were asleep at the wheel in this country, and they allowed that to happen, and I'm stopping it.
I'm a UN ambassador. Will that still be a cabinet-level position, sir, or not?
I don't know. I haven't determined that yet. That's a good question. I'll make a decision. He's a very good guy, but I'll make a decision.
Mr. President, what is your relationship with Laura Loomer? What kind of influence with Laura Loomer? What kind of influence does she have in the White House? I think she's very nice. I mean, I know she's known as a radical right. But I think Laura Loomer is a very nice person. I've known her for a long time. And, personally, I think she's a patriot. And she gets excited because of the fact that she's a patriot. And she doesn't like things going on that she thinks are bad for the country. I like her. Okay? President, after Sydney Sweeney, it came out this weekend that she was a registered Republican. Any thoughts on that?
That who was?
Sydney Sweeney. She's like a very hot actress right now.
She's a registered Republican?
Yes.
Oh, now I love her ad. Is that right? Is Sydney Sweeney? You'd be surprised at how many people are Republicans. That's what I wouldn't have known, but I'm glad you told me that. If Sydney Sweeney is a registered Republican, I think her ad is fantastic. Okay, thank you very much, everybody.
Thank you, Mr. President.
We're just hearing some comments as President Trump is speaking with reporters in Allentown, Pennsylvania, really covering sort of some of the day's news, including, of course, the jobs numbers that we had on Friday, expectations from the Fed, also talking about the situation when it comes to Russia. Of course, there was some sort of concern, as President Trump said, that he had moved U.S. nuclear subs after trading barbs with Russia. We've seen no sort of interest from President Putin in terms of changing his strategy when it comes to Ukraine. This is obviously a source of a real frustration for President Trump. He wants to have that ceasefire done. He also wants to have an improvement when it comes to the humanitarian crisis in Gaza as well. He has been speaking about sending Witkoff to Russia on Wednesday or Thursday, presumably to continue those conversations, but also canvassing things like, replacement for key personnel at the Fed as well.
Yeah, very wide-ranging discussion. Of course, Adriana Kugler stepping down. He says he's got a couple of names in mind. We'll hear something in the next few days in regards of that, and also a new statistician for the Bureau of Labour in the next few days as well, which has had a profound impact on yields, that revised jobs data.
Yep, weighing in on Sydney Sweeney's jeans ad there at the end as well.
Yep.
Yeah. Let's take a look at one of the other big stories that we're following, which, of course, is the action on the bond market. Of course, we saw that big rally in U.S. Treasuries coming through, yields just falling through the floor on Friday as we had the revised numbers to those payrolls numbers, really casting a shadow over what has been previously a pretty resilient picture for the U.S. economy, in particular when it comes to the labour market. It's now really changed the trajectory of expectations of at least 2 Fed rate cuts by the end of the year. Take a look at how we're seeing really some consternation as we progress into the first 10 minutes or so of trading for equities. Nikkei 225 down by just about 2% there. We're seeing some losses there for the topics. Dollar yen holding at that 147 level, and we did see that move across global bonds being reflected in JGBs as well, Paul.
Well, we've just opened for trade here in Australia as well. We do have a staggered open, so, hard to get a read on how things are going. But at the moment, we're seeing some early losses. We're off about a fifth of 1%, which is perhaps to be expected considering the lead-in we got from US markets. A lot of action, though, in the bond space. We mentioned the vicious moves that we saw after the sacking of the statistician at the Bureau of Labour, and those jobs numbers got so heavily revised. We did see the 2-year yield yield for the US seeing its steepest drop on record on Friday, and we're seeing things appear to stabilize a little bit now. Well, joining us now is Jeff Grills, head of US cross markets and emerging markets debt at Aegon Asset Management. Thanks so much for joining us today, Jeff. I do want to start off, if I can, with some of these assets that are sensitive to what's happened in the US. I want to kick off with the dollar. It had a great week, but how durable is this rally? We do have some EM investors betting that weak dollar days may be coming to an end.
I think that the weak dollar story has just paused for now. The expectation is that over the next 2 to 3 years, we should expect, at least we expect the U.S. dollar to continue to weaken some. It had gotten to an overvalued position with a lot of these measures that the U.S. administration has been doing in terms of tariffs. We expect a little bit more of that isolationist trade away from the U.S. to occur. But the strength of the last week was just really a correction from the weakness we saw before. I think for the remainder of the year, it should continue a mild depreciating trend, and everybody's going to be watching the Fed to see what they do now with expectations for this cut in September.
Yeah, let's talk about that as well, because we do have a chart illustrating that the market's pretty much got September firmly priced in now, but we've got, I think, a couple more inflation prints to come, another jobs report before then as well. So in terms of the data, and the Fed is data dependent, how baked in do you think that cut really is?
Well, I think Friday's data release is going to create a much better runway for the Federal Reserve and the FOMC board to cut rates in September. We've been between 1 to 2 cuts for this year. We think that ultimately a Fed funds rate is going to get down to 3.25. One thing that they're going to have to play with is that we do anticipate some inflationary pressures feeding through to the data, which is a reflection of tariffs being implemented here in the second half of this year. But I would reiterate that tariffs are really a one-off adjustment to prices. They don't create long-term inflation. So while we'll see that pass through going through here, and maybe the Fed trying to navigate that, they will eventually get back to inflation that will run closer to the Fed's target. I think the Fed will take comfort with this recent labor market data to ease this year, likely twice out of the next 3 meetings. And I think that'll provide some comfort to the market until we get the tax bill and everything else from the big, beautiful budget kicking in 2026.
Of course, one deal that is not finalised, in fact, we see kind of a possible extension to the trade truce, is a situation with China. How much does that impact uncertainty across emerging markets?
Well, I think the story with China is really down to what's going on in China. You've had a weak labor market. You've had just an inability for the consumer to feel comfortable to spend. In terms of the tariffs, I mean, I think we're well past peak tariff concern with regard to China. And I think China played it very well in terms of the rare earth metals and making sure that the U.S. continued to have access to that. So I don't think that the U.S. administration is going to look to ratchet up much in terms of China. They'll try to negotiate, get to some sort of trade deal. I think Russia is going to be the next couple of weeks focus, given sort of the movement of submarines and a shortening of the time frame. But China, the good thing about China is that while growth is probably likely to come in below their official target, they do still have plenty of stimulus levers to pull that they can use to continue to keep China at least growing 2 to 3% and maybe 3 to 4%, which is really where we're coming out. 4% is our official estimate for this year.
When it comes to global bond markets, do you think this bet that we're seeing playing out from Friday into the Asia trading week has momentum?
Well, we've been of the view that U.S. rates will go lower heading into 2026, or at least our forecast for year end is closer to 4.10. We think that we can get sub 4 in 2026. I think the concerns on the fiscal deficits will be offset by a lot of the tariff revenues that we're seeing. I mean, when you project $300 billion in fiscal deficits, the incremental from this recent bill, you're getting close to $300 billion in tariff revenues. So that's going to be a big offset, and I think that will alleviate pressure. I mean, you just heard Trump talking about how they're going to focus on paying down debt. I'm not sure how well they're going to do that, but I don't think there's going to be as big a concern in terms of fiscal deficits adding to the debt. And we see with the Fed in more of an easing mode, inflation coming down in 2026, that this could extend somewhat with U.S. rates going lower. I mean, what we saw on Friday really was just a flight to quality, but again, I think the trend overall will be lower in yields.
Jeff, great to have you with us. Jeff Grills, head of US cross markets and emerging markets debt at Aegon Asset Management.
Let's take a look at how we're tracking in Australia at the moment. The broader index is somewhat weaker, off by about 1/5%, but we are seeing solid gains for Beach Energy. All the other major oil and gas producers in Australia are weaker today, but Beach Energy, a bit of an outlier because we've just had results. Underlying profit, 450 million Aussie dollars. That was up 32% on year, and it also beat analyst estimates. The final dividend per share, 6 cents, better than the 2 cents that we had the year prior. So that's why you're seeing Beach Energy there up 4%, a bit of an outlier, but all the other oil and gas producers in Australia are a little bit weaker. This, of course, off the back of that OPEC Plus decision to further increase production by 547,000 barrels a day from next month. More ahead on the Age of Trade. This is Bloomberg.
I expect that those batters are more or less locked in, although there'll have to be some, dancing around the edges about exactly what we mean when we do this or that. For the deals that aren't ready yet, they're going to get the reciprocal rates, soon, and then we would expect that there might continue to be negotiations with those countries.
That's White House National Economic Advisor Kevin Hassett on tariff rates. For more, let's get to our East Asia Government Editor, John Herskovitz. So, John, what are the prospects for the US and Canada reaching some sort of trade deal?
Sure. We have the indication that Prime Minister Carney and President Trump are going to have talks in the next few days. No time is set for that. So that in itself is kind of promising, but there's just a lot of uncertainty there. Going into the talks, Canadian Trade Minister LeBlanc showed some sort of optimism, and just how they're going to get there is difficult. We have the US-Mexico-Canada trade agreement, which may provide some sort of framework for this, but Carney's also caught in a difficult position. He came to office with promises to be tough on Trump and the U.S. trade policies, but he also has to balance his economy, trying to find some sort of deal. So Canada's looked at retaliation. They're trying these talks. Trying to get some sort of agreement between the two is difficult, but there are the talks, and that is promising for the developments between the two.
So India has, of course, been caught in the crosshairs between Russia and the US, but are they standing firm when it comes to Russian oil purchases?
India has given some indication that it wants to wean itself off of Russian oil, but there's no formal directive for it to happen. India imports about 35% of its oil from Russia, somewhere around there, and it's a key portion of its energy input. Now, India is really caught in a bind. It's also trying to walk a tightrope. It has good relations with Russia. Russia is a significant exporter of arms to India. I think about 2010, 2015 is about more than 70%. Now it's down about 30, 40%. But Russia and India are trade partners. Russia, I think, is number 4 for India. But India also relies heavily on trade with the U.S. It's got caught in the crossfire with Trump putting in punishing tariffs on India for its reliance on Russian oil and also, to a lesser extent, Russian arms. For the U.S., India is also a key player. It relies on India as a balance to China in the Indo-Pacific region. It has Quad relationships with India, Japan, and Australia in a group that's kind of seen as a hedge to China. So it's difficult for the U.S., it's difficult for India, and how it's going to play out, it remains to be seen.
Yeah, India's also got a major domestic consideration as well in terms of protecting small-scale farmers, and in that regard, Narendra Modi's urging its consumers to buy locally. What sort of impact could these buy local campaigns have on a potential trade deal with the US?
Sure. It's a little bit of the echo of Canada with the buy locally. Now, one of the key issues in the trade deal with the U.S. was U.S. GMO crops. India is trying to protect its farmers. It's a key voting bloc. There are some elections coming up which are essential for Modi and his party to win. This may rally support for his prospects and also to get farmers on board. So we'll see how it plays out, but it's part of the domestic politics in India. The farmers, Modi needs the support of farmers in the elections if he wants to keep his base strong and have power that will promote his government. So farmers are key, and this Buy India could be something that helps him and also overcomes the pressure from the U.S. to buy more farm products from America.
All right, Bloomberg's East Asia government editor John Herskovitz there. Well, Russian President Vladimir Putin says his war goals in Ukraine are unchanged. And this comes as the Kremlin continues to rebuff U.S. pressure for a ceasefire with Kyiv. Let's get to Bloomberg's Michael Heath now for more on this. So, Mike, President Trump's also set a deadline of August 8 for Vladimir Putin to do something in terms of ending the war in Ukraine. No sign of acting yet. Are we on the cusp of another taco moment?
Yeah, it's an interesting point, Paul. Putin he spoke late last week, and he was at a meeting with Belarus's president, and he sort of indicated that everything was going well in the war, and that there was no prospects of truce. And even in the reporting we sort of had, President Trump was wondering out loud whether his threats would have any impact on Putin and what he's doing there. So I mean, really, the US is going to have to actually step up and act on some of these measures. I mean, it's the only way that Russia is going to take seriously what it says. I mean, it's fairly clear from the early months of the Trump presidency that the talk or the personal relationship that President Trump had presented himself as having, they don't amount to much in terms of international relations, which I think most experts saw that as being the case anyway. So we're still at the same moment, and you have, Putin did say that that they needed to set up some working groups to look at the politics and the social side or whatever. I mean, sort of classic Russian deflection tactics. But Ukraine's president immediately said, yes, we're ready to talk, etc. And poor old Volodymyr Zelensky has to be seen to be wanting peace at every turn just to keep things straight with the Trump administration. So we're sort of still where we are. But I mean, if something does happen on the 8th, that we do get, say, these secondary sanctions and Russian oil, comes into the firing line there, that could make Russia move. I mean, oil is obviously the lifeline of its economy. So, it's really going to see whether the US actually acts this time.
And, of course, on a campaign of no more wars, but we know that there are multiple conflicts globally still going on. President Trump just a few minutes ago saying that when it comes to Gaza, they want to get the people fed. And, of course, we had these extraordinary scenes across the Harbour Bridge here in Sydney over the weekend. Police estimating at least 90,000 pro-Palestine protesters. The organisers, of course, saying that their estimates put that number at 3, potentially 4 times as much. But, you can see some of those pictures now, even in the torrential rain. We had that big turnout. This is the first anti-war protest that we've seen across the iconic Sydney Harbour Bridge to support Gaza. And so much of this has been sort of galvanised by the terrible pictures that we've seen of the humanitarian crisis. Is this something that the Australian government is reflecting on, do you think, in terms of its policy settings?
I think it is, Heidi. I mean, look, there has been a movement, and you're right. I mean, it's the television images that are the most dramatic effect. And it's interesting, just sort of reading the Israeli press and their side, and they're sort of reflecting on how things are changing globally in terms of people's views on them. I mean, the Australian public is extraordinarily apathetic politically, let alone when it comes to international politics. So this is an amazing scenes here, really. But there were also protests in Israel, calling for an end to the war and the release of the hostages. I mean, they're sort of getting to this point now with everybody where enough is enough. But you've got this difficulty of Hamas holding the hostages and then the Israeli government not wanting to engage. So it's a bit of a Gordian knot there that needs to be untied.
Bloomberg's Michael Heath there. More ahead on the Asia trade. This is Bloomberg. take a look at what we're watching across the commodities complex as, of course, investors continue to process the implications of not just the tariffs and the trade war, but also some of the payroll numbers that we saw out of the US suggesting some wobbliness over the US labor market and implications for more Fed easing, or sooner Fed easing, I should say. Take a look at Brent crude. We're trading off by just about 0.5% at the moment, along with New York traded crude after OPEC Plus agreed to another major output increase, stoking concerns about the global oversupply situation at a time when we're seeing, of course, global demand also looking pretty shaky. Goldman Sachs saying that OPEC Plus policy remains flexible and the geopolitical outlook uncertain. We're also seeing some of those considerations when it comes to OPEC Plus to pause hikes as OECD stockpiles is expanding. That's the latest view from Goldman's this morning, maintaining their 2026 Brent forecast at $56 a barrel after that OPEC Plus decision. Also watching copper after what has been, of course, a frenetic sort of couple of sessions of trading when it comes to copper prices, but we're also seeing that China could see the need to trim their record copper output on a persistent shortage of ore. Let's bring in our oil and shipping reporter, Waylon Soon. And so still a lot of unanswered questions as to what the next move is for OPEC Plus.
Right. Thank you, Heidi. And so what we have overnight, over the weekend, is hearing that the OPEC has agreed to increase output by 547,000 barrels per day. And that's pretty much expected. And so what that leaves for us for the oil markets in the months and weeks to come is at the September review, where they will consider whether the remaining 1.66 million barrels per day, are they going to resume production of that? That is still very much up in the air. And we can tell from what we've heard over the weekend that the investment banks, the Wall Street banks, are still thinking that that's pretty much still up in the air. It's OPEC is still holding its cards close to its hands. But for now, I think the concern is still the supply glut that we expect to see in the oil markets.
Yeah, and in tandem with the supply glut, what's the demand picture look like? How is that holding up at the moment?
Right, Paul. So what we have seen over the weekend on Friday is with the U.S. jobs data, oil prices really took a plunge, right? And so what we are seeing is that the market is still very concerned over the weak demand. And of course, we have the U.S. President Donald Trump promising more tariffs on different trading partners. And so what we are getting a picture past this summer peak season for oil demand is that demand is going to drop slowly. And we also think that the U.S. trade war with several of its trading partners is going to hurt that demand even more. And what we are seeing also from the U.S. stockpiles and also Chinese economic data, that doesn't really paint a really good picture for oil demand. And so with OPEC promising to resume what they have promised over the past few months and weeks, that just adds to the glut that Wall Street banks are really expecting.
All right, Bloomberg's Waylon Soon there. Let's take a look at how APAC, Asia-Pacific bonds are performing at the moment, because, of course, we did see a big spike in yields, or a big drop in yields, I beg your pardon, after the revision of the jobs numbers in the United States and the subsequent sacking of the Bureau of Labor statistician. We are seeing things settling down a little bit now across the Asia-Pacific. The yield on the Aussie 10-year not moving a great deal, 4.315 at the moment. It's a similar story for China and Japan bonds as well, and the bond market now pricing in a 90% probability of a rate cut from the Fed come September. Well, Cleveland Fed President Beth Hammack says the U.S. labour market still appears healthy despite Friday's disappointing job numbers, and she told us the Fed will continue to carefully monitor the data.
It was a disappointing report, to be sure, but when I look at the data, we don't try not to make too much of any one individual report. And so we look at the confluence of data, we look at the longer term picture. What we have is a labor market that is showing signs that we should be watching carefully. Having the headline numbers come down makes sense to me, given what we've seen happening on the immigration side. And the headline number on unemployment, which is the most reliable indicator we have, is still within that 4.1 to 4.3 range that it's been at for the past year. So it looks like like a healthy labor market that's still well in balance, but with some disappointing signs that we should watch very carefully.
Well, the one thing that caught everybody's attention is the revisions. We went from 147 in June to just 14,000. And I want to point out the statement from Chris Waller earlier today on why he dissented. He had a line in there that said basically, when labor markets turn, they often turn fast. Does that suggest maybe that you made a mistake by not moving in July?
I feel confident with the decision that we made earlier this week. We have to look at the whole picture of the data. When I step back and look at where we are, I see a labor market that is largely in balance. Again, today's report is just one report. We'll watch it carefully. We'll look to see if the dynamism in the labor market is picking up, because that's been something that we haven't really seen. If you have a job, you're able to keep your job, but if you don't have a job, it's harder to find one. But in aggregate, we're still seeing unemployment in that 4.2 range where it came out today, but it's been 4.1 to 4.3 for the entire year. We're seeing pressure on the inflation side of our mandate. That's where our miss has been bigger, and it's been lasting for longer. We haven't hit on inflation in 4.5 years. And when I'm out talking to people across the district, whether it's Wheeling, Toledo, Cincinnati, what I hear from people is that the pain of inflation is really biting. They're making very difficult choices. They're trading down from buying ground beef to buying hot dogs. The $400 emergency fund that they have, they're not able to stretch as far as they used to. And so we have to balance those two sides of our mandates when we think about setting correct policy. And we have to look at, if we're missing, by how much and for how long do we expect those misses to last? And right now, we're missing by much more on the inflation side than we're missing on the employment side.
The Cleveland Fed President Beth Hammack there speaking to Bloomberg's Michael McKee. Some of the other stories that we're following this hour, and President Trump has fired the Bureau of Labor Statistics chief, Erica McIntyre, hours after the agency released weaker than expected jobs numbers. The president called the data rigged, claiming political bias. Economists from both major parties are slamming Trump's move as baseless. China has accused the U.S. of exploiting a flaw in Microsoft email servers to steal military data and launch cyber attacks on its defense sector. The Cybersecurity Association of China says U.S. actors have been linked to two major cyber attacks on Chinese military companies. A U.S. embassy spokesperson didn't comment on the allegations, but says China remains the most persistent cyber threat to the U.S. More ahead on the Age of Trade. This is Bloomberg. Watching Nippon Steel this morning, with the company aiming to boost U.S. steel profit over the next 3 years. They'll be implementing improvements to boost U.S. Steel Corp's profits over that period. They are expecting that profit at 80 billion yen for the 9-month period ending March, aiming to extend that out to about 250 billion yen after fiscal year 2028. Vice Chairman Takahiro Mori saying that the firm believes the best way to continue growing is through U.S. steel, despite the business environment potentially getting more difficult with American tariffs. So this after, of course, Nippon Steel finalised that long-delayed acquisition of U.S. steel back in June. We are seeing a little bit of downside, at 2.7% in fact lower for Nippon Steel, but trading lower alongside, of course, the broader market as well, as we see that sort of risk-off sentiment and the big move across bonds and JGBs. Take a look at Nintendo, which has kept its Switch 2 forecast unchanged despite a pretty robust start to sales as well. There is a sort of expectation that we could eventually get that guidance after they've hit 40% of the Switch 2 sales goal, but at the moment there is still sort of some concern over the consistency of those numbers. Nintendo is still trading up by about 0.4%. The overall downward trend of Japanese stocks, so being bucked here by this company. The quarterly sales did show some pretty strong sales when it comes to the Switch 2 console. More than 6 million units of the console sold over the first 7 weeks on the market. That forecast of 15 million sales by March is unchanged. Some of the other stories on the corporate front. Tesla has been told to pay $243 million in a lawsuit over an autopilot crash in Florida that killed a young woman and seriously injured her boyfriend. A jury in Miami federal court found that Tesla was partly to blame for the collision in 2019. Tesla says it will appeal the verdict, adding that decision is a setback to its efforts to develop life-saving auto technology. More than 3,000 Boeing defence workers are set to go on strike for the first time since 1996 after rejecting a contract offering 20% wage hikes. Boeing says it's ready for the work stoppage, but labour unrest adds pressure to its defence unit, which accounts for 30% of revenue. The company says it will withdraw its current offer to workers if it's not ratified by midnight Sunday in the US.
Well, BMW says its new electric SUV will be competitive in every market, and that includes China, which already faces intense competition. CEO Oliver Zipse also told us exclusively that the car maker is close to reconsolidating its dealers in China.
Well, we're not waiting for the Neue Klasse, which hits the market in China in the second half of 26. So shortly after we launch it here in Europe. We're not waiting until that car is launched over there, because a lot of capabilities, especially on the digital side, you will already see currently in the cars. So we will see fairly stable volumes, maybe a little bit less than last year, but China is already stabilizing for us. And then, of course, that will give an additional growth momentum in China when this car launches the car. So we will be fairly stable this year, and by the end of next year we will see some growth there. We're very sure, especially because this is also a symbol of the renewal of BMW. Yeah. A completely new user experience, which is quite unique also in China.
In China, the competition is intense, particularly when it comes to the software and it comes to the technology. You have companies like Xiaomi coming out with the SU7 priced at about $40,000. Some have described it as a Ferrari at $40,000. What gives you the confidence you can compete in China?
Past, current, and future competencies we have. When you look how strong BMW is as a brand, and what you mentioned, the turn down in the industry, this was also partially intended by us, because we were retracting from markets which were not profitable, simply as that. And as everyone knows, there are market segments where you cannot be profitable, and we ask ourselves, growth itself does not have a value in itself. If it's not profitable, we retract. And what we see in the marketplace is various things. High technological advance, and we will give that answer with that car, that we're absolutely competitive in every market, including China. But we are not staying in a market which is not profitable for us. And how that will develop, how prices will develop this year and next year, this has to be seen. And we already see this year stabilizing prices, and that this is partially an extremely unhealthy competition, that everyone knows that.
And you have not been involved in that price-cutting competition in China. BMW has not been part of that, but you have been supporting your dealership network. Does that support continue?
You're always part of a market, but we have not been continuous specific markets and where it was not profitable. At the same time, we're reconsolidating our dealer network. That's happening at the same time to what is happening in the market. And by the second half of this year, we will be through with that. We have less dealers. Mm-hmm. We have more larger dealers. We have more profitable dealers. We have more experienced dealers. So that is happening at the same time. Why is that necessary? We have been growing by leaps and bounds in China for the last 15 years. And I think maybe it's even a good thing to take a break and consolidate our business, and that is what's happening right now.
Does that consolidation mean reduced workforce, reduced headcount in China, like some of your competitors, some other automakers have cut headcount? Is that something you're doing or planning to do in China?
We also do that. If you have less market volume, of course you adapt to that. The main thing is you have less but larger dealers, which means more profitable dealers, more efficiency.
It's BMW CEO Oliver Zipse speaking to Bloomberg's Tom McKenzie. Well, Japanese automakers Toyota and Honda are among key earnings to watch this week. Analysts see their results painting a mixed picture as a stronger yen and US auto tariffs eat into profit. Bloomberg's earnings specialist Raina Sasaki joins us now for more from Tokyo. So, Raina, tell us about the core setup and what do analysts expect to see in the earnings when Toyota and Honda come out later this week?
Yes, so Toyota and Honda are reporting their first quarter earnings later this week, and we are likely looking at a mixed earnings picture for both companies, strong unit sales but falling profitability. Let's start from Toyota. The company saw record global retail sales in the first half, up 7% in Japan and US and 10% in China. That momentum was driven by pre-tariff purchases, hybrid demand, and localized dealers' incentives. But the analysts, including Bloomberg Intelligence, expect a decline in the first quarter operating profit, with margin hit coming from three directions. One is the supply chain support costs, and the stronger yen, and an early impact from U.S. auto tariff. Then Honda faces a similar macro pressures, and while U.S. sales rose 9%, it's contending with weakness in Japan and China, down 14% and 25% respectively. And the bottom line is that the top line is holding, but the input cost inflation and FX risks are compressing their earnings power.
What are they saying about the fiscal year ahead, particularly when it comes to all of these uncertainties over U.S. tariffs, FX volatility as well?
Yeah, so both are guiding conservatively, with margins reflecting tariff impact, pressures from stronger yen, and rising cost bases. Toyota projects 3.8 trillion yen in operating profit for this fiscal year, down from 4.8 trillion yen last year. The margin is seen shrinking from 10% to 7.8%. They're building in assumptions for higher R&D, elevated promotional spend, and a stronger yen, currently modeled at about 145 yen to a dollar. And then Honda's guidance is even more cautious, and they're forecasting 500 billion yen in operating profits, down from 1.2 trillion yen. That bakes in 650 billion yen gross tariff hit, offset by 200 billion yen in countermeasures like price hike, reshoring, and localized sourcing, resulting in a net 450 billion yen impact. So both automakers are emphasizing the cost control, regional diversification, and supply chain rebalancing to preserve profitability under the new tariff regime.
How about broader trends? Is there anything investors should be watching for here beyond just the headline numbers?
Yes. So there are broader shifts unfolding across Japan's industrial exporters, and it's already visible in the macro data. In July, Japanese automakers cut U.S. export prices by 19%, the steepest drop since at least 2016, to stay competitive amid tariffs. That's directly hitting their margins. And the Bank of Japan's Tankan survey shows the declining confidence among automakers, and Japan's total export fell for the second straight month, led by the auto and steel shipments. This suggests a pattern that Japanese companies are prioritizing the market share over short-term margin preservation in their largest export market, which is the United States, that made up 20% of total export in 2024. The key issue now is whether and how companies pass on additional costs. The Goldman Sachs noted that if they cannot pass those additional costs, and the margin pressure may broaden across sectors. So while this quarter is about managing pressures and damage from the U.S. tariffs, the rest of the year will be about the pricing power, production flexibility, and whether the tariff relief materialize. And investors should be watching the second half guidance language very closely.
Bloomberg's earnings specialist, Raina Sasaki, they're taking a look at some of the auto names that we'll be following. And we'll get more on the global car industry coming up when the China show speaks exclusively with the Asia CEO of the Vietnamese EV maker VinFast. That's coming up at the Times on your screen. Much more ahead. This is Bloomberg.
We're just hearing from Japan's lead trade negotiator, Akazawa-san. He says they're waiting for a deal in writing which might have delayed a levy cut. He also says the U.S. is trying to change the rules and norms of global trade. A little bit earlier, he also said that the trade deal isn't on paper, but that's the same story as with the U.S.-EU deal. We heard from Japan's Prime Minister Ishiba as well earlier, saying that implementing this trade deal is going to be a lot harder than agreeing. So we shall watch how all of this unfolds, Heidi.
Well, in the meantime, Hong Kong has eased some rules around new stock listings in the city, potentially bolstering what's already been one of the hottest markets in the world for IPOs this year. Let's bring our China correspondent Min Min Lo. So what are the changes that are being rolled out?
Yes, Heidi, a couple of big changes. One is that the minimum float requirement for mainland-listed companies to list in Hong Kong has been reduced from 15% of the total number of shares to 10% of total number of shares. And additionally, also, so there is the retail allocation of shares has also been reduced to 50%, reduced from 50% to 35%. So what this does is that it gives institutional investors greater pricing power. Although previously, if there is a lot of strong interest from retail investors, there's also a clawback mechanism to allocate more to retail investors. And the purpose of this is to prevent overpricing during book building, because that raises the chances of a price slump after a listing. But altogether, plus there is also the shortening of the approval process to 30 days for mainland listed companies to list in Hong Kong. So all in, these measures will likely increase the favorability of Hong Kong as a destination for Chinese companies to list. And this is coming against the backdrop of a very strong bumper crop of listings already this year, with CATL, the world's largest listing, being in Hong Kong as well. That propelled Hong Kong into the second largest market for share sales this year. And this is, of course, part of the Hong Kong government's effort to boost the city as one of the premium destinations for financial investors.
All right, Bloomberg's China correspondent Min Min Lo there. Let's take a look at how futures are tracking as we look ahead to the open in China and Hong Kong at the bottom of the hour. Similar story to what we're seeing in the markets that are open now, actually. It's a bit of a mixed picture. We're expecting to see quite a bit of weakness in Taiwan when we get underway. We've already got stocks in Japan off by more than 2% at the moment. S&P futures, though, in positive territory. It was a somewhat brutal end of the week for U.S. equities. The Nasdaq was off by almost 2.25%. Not a great deal of change there for the yuan at the moment, and FTSE Chinese futures pointing down by about 0.25%. All right, that is it from the Asia Trade Markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show up next. This is Bloomberg.